After studying this module, we shall be able to explain the meaning, nature, and features of factoring, discuss the mode of operating of factoring, focus on services of factoring organizations, understand the various types of factoring, emphasize costs, benefits, and suitability of factoring, and finally, differentiate between factoring, bills discounting, and other short-term sources.
In case of trading and manufacturing firms, a lot of working capital is required in the form of trade debts. The collection of such debts requires a lot of time. So, factoring organizations help in collection of such debts by purchasing a firm's trade debtors. As a result, firm saves a lot of time and can focus on other main activities of its business.
In case of trading and manufacturing firms, a lot of working capital is tied in the operating cycle in the form of trade debts. The collection of such debts is very difficult and requires a lot of time. Factoring is the financing given to such trading and manufacturing firms by purchasing trade debts and helping in their collection. It is generally done by banks and specialist organizations known as factoring organizations. Factoring's origin lies in the financing of trade, particularly the international trade. It is said that factoring originated with the ancient Mesopotamian culture with rules of factoring preserved in the Code of Hammurabi. Factoring as a fact of business life was underway in England prior to 1400 and it came to America with the Pilgrims around 1620. It appears to be closely related to early merchant banking activities. The latter, however, evolved by extensions to non-trade related financing such as the sovereign debt. Like all financial instruments, factoring evolved over centuries. This was driven by changes in the organizations of companies, technology, particularly air travel and non-face-to-face communication technologies, starting with the telegraph, followed by the telephone and then computers. These also drove and were driven by modifications of the common law framework in England and United States. Governments were latecomers to the facilitation of trade financed by the factors. English common law originally held that unless the debtor was notified, the assignment between the seller of invoices and the factor was not valid. The Canadian federal government legislation governing the assignment of monies owed by it still reflects this stance and thus provincial government legislation modelled after it. As late as the current century, the courts have heard arguments that without notification of the debtor, the assignment was not valid. In the United States, by 1949, the majority of state governments had adopted a rule that the debtor did not have to be notified, thus opening up the possibility of non-notification factoring arrangements. Originally, the industry took physical possession of goods, provided cash advances to the producer, financed the credit extended to the buyer, and ensured the credit strength of the buyer. In England, the control over the trade thus obtained resulted in the Act of Parliament in 1696 to mitigate the monopoly power of the factors. With the development of larger firms who built their own sales forces, distribution channels, and knowledge of the financial strength of the customers, the need for factoring services was reshaped and the industry became more specialized. By the 20th century, in the United States of America, factoring was still predominant form of financing working capital for then high growth rate textile industry. In part, this occurred because of the structure of US banking system with its myriad of small banks and consequent limitations on the amount that could be advanced prudently by any one of them to a firm. In Canada, with its national banks, the limitations were far less restrictive and thus factoring did not develop as widely as in the United States of America. Even then, factoring also became the dominant form of financing in Canadian textile industry.
Now we shall discuss the mode of operating of factoring arrangements. Generally, three parties are involved in factoring arrangements, namely factor, client, and customer. Factor helps in converting credit sales into cash sales. Before client sells his goods on credit to the customer, he makes the contract of factoring. Then the client sends the customer's order to the factor for evaluating the credit worthiness of the customer and approve it. Then the client sells his goods on credit and debt is generated. After all this, client gets the funds from factor depending upon the type of factoring on selling his debt, and customers have to make the payment to the factor only. Factoring organizations charge some fees from the client. Let us now discuss the features of factoring. First feature is client identification. The factor determines the clients with whom he wants to deal and fixes the credit limit they can grant. Next feature is related to finance. The factor provides money against the debts, which is generally 70 to 80% of debt amount, and charges a commission for it. The factor makes the full payment of debt on debt maturity or when debt amount is collected, whichever is earlier. The next feature is related to fees of factoring, which has already been discussed.
Thus, factor helps in converting credit sales into cash sales and generating finance. Before client sells his goods on credit, he makes the contract of factoring with the factor specifying rules and regulations. Then, client sends customers' orders to factor. Factor evaluates the credit worthiness of the customer and approves it. Then, client sells his goods on credit and debt is generated. The client gets 100% finance from factor on selling his debt and debtors have to make the payment to the factor only. This is the most common factoring contract. In some other cases, factor gives only 80% of the debt amount and rest 20% is given on receiving payment from debtors. The factor charges fee from the client, which is called factoring charges, which includes service charge, which is charge for the service of the factor, interest payment. It is the interest on financing amount at the prevailing bank rate of interest. In India, it ranges between 2.5% to 3%. In case of bad debt, factor may come to the client or bear loss himself, which depends on type of contract.
It is very important to learn about the nature of factoring. Factoring has three different aspects. Firstly, it is a financial function as it helps in providing finance against debt and thus helps in overcoming the cash crunches. Secondly, it is a management function also as it helps in the effective management of assets. It helps to convert non-productive assets, that is, debtors, into productive assets, that is, cash. Lastly, factoring has a legal aspect also. It specifies a legal relationship between the client and the factor which has certain clauses legally binding on both the parties. Let us now proceed to understand the services rendered by factoring organizations. Apart from financing against debts, a factor provides a number of services. We will discuss the various services one by one. The first service is financial assistance, where the factor purchases the debt from its client and provides finance against it. The next service is credit administration. In this service, a factor helps the client in assessing the creditworthiness of a customer before granting credit. He also fixes the maximum amount of credit to be granted to a customer. A factor prepares a number of reports for effective management of credit and its collection. The third service is credit collection and protection. A factor helps in the timely collection of debts. The factor provides full or partial safeguard against bad debts, depending upon the type of factoring agreement. The next service is related to sales ledger management. It involves management of sales and ledger of client. Apart from the above four, the factor provides various other services as well, like information about prospective buyers, finances and purchases of inventories, opening up of letter of credit, etc. We shall now proceed to the types of factoring. There are mainly two types of factoring arrangements. The first is domestic factoring. In case the parties are in the same country, it is called domestic factoring. The second is international factoring. When factoring arrangement is within exporters or importers, it is known as international factoring. In this type, the client is the exporter, the customer is the importer, and the factor may be export factor, that is, factor from exporter's country, and import factor, that is, factor from importer's country. Now we shall discuss the various forms of domestic and international factoring one by one. Let us first discuss the various domestic factoring arrangements. In case of full service, non-recourse factoring, complete risk of bad debts is borne by the factor. The client gets 80 to 90% amount of debt at the time of selling debts and the remaining amount afterwards. In case of full service recourse, the factor provides only debt financing and no protection against any risk. That is, the risk of bad debts is borne by the client. In case of bad debts, the factor can go back to the client and recover his loss. In case of advance factoring, the finance is granted to the client when the debts are sold, whereas in case of maturity factoring, financing is done when the credit is matured. It means factor only performs the function of collection in case of maturity factoring. In case of bulk factoring, factor only performs the function of financing. All other functions like creditworthiness, credit management, etc., is done by the client himself. In case of undisclosed factoring, the factor performs all the functions without bringing it to the knowledge of the customer. In limited factoring, the factor purchases a limited invoice of the selected customers rather than the entire amount. In case of customer-based factoring, Factoring agreement is initiated by the customer rather than the client. The customer contracts the factor for converting his credit purchase into cash purchase and ensures the factor for future payment.
In this case of full service or non-recourse factoring, complete risk of bad debt is borne by the factor. Client gets 80 to 90% amount of debt at the time of selling debts and remaining afterwards. Factor maintains all accounts of customers who have to pay directly to the factor. It is also called old line factoring. It is suitable in following cases. The amount of debt factored is very high. A large number of customers have to be managed by the client. The client wants to get 100% of the amount of debt. Full service recourse factoring provides only debt financing but not protection. That is, the risk of bad debts is borne by the client. In case of bad debts, the factor can go back to the client and recover his loss. Thus, this is more risky for the client and thus the fee paid by him is comparatively lesser. It is suitable when the debt per customer is low and number of customers to be managed is less or the customers are not credit worthy. Recourse or non-recourse factoring can again be classified as advance and maturity factoring. In case of advance factoring, finance is granted to the client when the debts are sold, whereas in case of maturity factoring, financing is done when the credit is matured. In maturity factoring, factor only performs function of collection. In case of bulk or agency factoring, factor only performs the function of financing. That is, he only grants finance against book debts. All other functions of assessing credit worthiness, maintaining accounts, credit management is done by client himself. It can be with recourse or non-recourse. Undisclosed or non-notification factoring. In this case, factor performs all the functions without bringing it to the knowledge of the customer. Factor operates in the name of a sales company through which customers deal with him. Thus, customers feel that they are dealing with the seller and not a factor. This type is available in United Kingdom to financing strong companies. Opposite to this is disclosed factoring, where customers have the knowledge of working factor. Limited factoring. In this case, the factor purchases a limited invoice of the selected customers rather than the entire amount. Buyer or customer based factoring. In this case, the factoring agreement is initiated by the customer rather than the client. The customer contacts the factor for converting his credit purchase into cash purchase. The customer ensures the factor for future payment.
Now we will discuss the various forms of international factoring arrangements. These are two-factor system, single factor system, direct export factor, direct import factor. Let us discuss each of these in detail. Two-factor system. It is the most common and effective factor arrangement. In this case, an import factor and an export factor simultaneously perform factoring services. Export factor transfers all information to the import factor. The import factor provides all credit related information about the customer. Export factor helps in financing and import factor helps in collection and sends the amount back to the export factor. In case of single factor system, the client makes the contract only with the export factor that enters into a separate contract with the import factor only in case of default. Credit risk is borne by export factor. Import factor only works as a sub-agent of the export factor. The third form is direct export factor, where agreement is made only between exporter and export factor and no other party is involved. All the functions are performed by the export factor himself. In case of direct import factor, an agreement is made only between importer and import factor and all functions are performed by the import factor.
International factoring is now being universally accepted as indispensable to the financial needs of small and medium sized exporters. It has the support of government bodies and central banks throughout the world, and more large exporters are using international factoring as well. But sometimes may customize the package or select only a limited number of services rather than the complete package. A global trade continues to grow. It transcends into opportunities for the factoring industry. Exporters have realized that it can help them to become more competitive in complex world markets. Many businesses that run to factoring companies are reassured to know that the industry is closely associated with banking sector. Although factoring companies remain highly specialized institutions, nearly all major banks now have factoring subsidiaries. This has enabled the industry to promote its services with greater success and to work for businesses of every size. Factoring has become well established in developing countries, in particular in those that are highly industrialized. In various Asian countries, the growth of factoring has been tremendous. Factoring is not advisable where sales are made for cash, in case of speculative business, for highly specialized capital equipment or goods made to order, if the credit period is more than 180 days, in case of consignment sale, sales to associated companies, or when sales are made to public at large.
Now we are clear about the meaning of factoring, its services, and different types. Let us now discuss its advantages. It has various advantages from a company's point of view. It helps in elimination of debt discount. It provides immediate finance and credit. It helps to remove the cost of credit administration as the factors have specialization in that. It increases the overall return for the company as cash may be used for many productive purposes. It improves the liquidity position of the company and thus the working capital requirement is used. It also provides the company protection against bad debts. It provides useful information about markets, customers, etc. Effective credit collection services of factor also help in improving creditworthiness of customers, thus reducing credit risk. Together with benefits, factoring has some costs as well. There are two types of costs associated with factoring, that is, monetary and non-monetary costs. Monetary cost includes commission and interest payment. Commission is paid for the services rendered by the factor, and interest is paid on the amount received as finance for the specified period of time. Non-monetary cost includes 2 points. First, if the company employs a factor for managing debts, it reflects poor management by the company, which negatively affects goodwill. And second, if the customers are widely scattered, factoring may not serve the purpose. As we all know, factoring and bills discounting both are ways of short term finance. But the question arises, what is the difference between the two? Bill discounting involves only financing against bills, but factoring involves financing, collection, and protection against debts. Bill discounting is always with recourse, where risk of default is borne by the company, whereas factoring may be with recourse or without recourse. The next difference is bill discounting is preferable when the debtors are creditworthy, whereas factoring can be taken up in case of risky debtors as protection is also provided by the factor. And the last difference is bill discounting is preferable only in case of lesser number of buyers, whereas factoring helps to manage a large number of buyers. Now let us see how factoring is different from short-term financing. As we have discussed, factoring involves financing, collection, and protection against debts, but short-term financing is concerned with financial activities only. Factoring charge involves service charge and interest payment, whereas in case of short-term financing, only interest payment is done by the company. The next difference is related to performing of functions. Factoring provides a financial as well as a management function, whereas financing is a purely financial function where management of debtors is done by the company itself. Factoring is much more flexible as the client can take finance as and when required. Such an option is not available in case of short-term financing. Let us now recapitulate what we have learned in this module. We have studied about factoring, its meaning, nature, and features. Factoring is the finance given to trading and manufacturing firms by purchasing trade debts and helping in their collection. Three parties are involved in factoring arrangements: client, factor, and customer. Factoring has three different aspects: financial, management, and legal aspect. There are mainly two types of factoring arrangements: domestic factoring and international factoring. Factor collects debts and also advances cash against debts to solve the liquidity problems of the client. For providing these services, they charge interest on advance and commission for other services. We have also studied the various costs and benefits of factoring. We have also studied the difference between factoring and bills of discounting. There is a difference also between factoring and short-term financing because factoring is not only related to financing activities but also involves collection and protection of debts.